Hey everyone, welcome back to the Capyank Duo channel. In today's video, we're diving deep into the latest economic updates for July 2025. Is the US heading for a recession? Why is inflation still stubborn? And most importantly, where should we put our money to stay safe and profitable during these uncertain times? Stick around because I'll also share investment strategies you can apply right now.
First, let's look at the global economy. After some stability last year, US inflation is still hovering around 3.8%, which is higher than the Fed's target of 2%. As a result, interest rates remain high at about 5.25%. And what does that mean? Loans for homes, cars, and even business credits are getting more expensive. The stock market? It's been volatile. The S&P 500 rallied briefly, then dropped again following weak job reports. Meanwhile, big investors are shifting their funds to gold and government bonds, classic safe havens. That's a clear sign that fears of a recession are still very much alive.
So what's the impact on everyday people?
If you live in the US, you probably feel it already. Groceries aren't getting any cheaper, mortgage rates are still above 7%, and car loans are pricier than ever. People are postponing big purchases, and businesses are slowing down hiring. This behavior could eventually drag the economy into a slowdown, and if things worsen, even into a recession. Now the big question. Where should you invest in 2025? 1. Gold. Investors are moving to gold because it holds value during uncertainty.
If you notice, whenever global uncertainty arises, whether it's a recession, war, or financial crisis, the price of gold usually rises. Why? Because gold has the characteristics of a safe haven asset, or a hedge against value. When inflation is high, interest rates are uncertain, or the stock market is falling, gold remains relatively stable in value and can even rise. For example, during the 2008 financial crisis, the price of gold skyrocketed from around $800 per ounce to over $1,800 per ounce in just 3 years. Let's look at a few examples. 2008 financial crisis. When the housing market collapsed and stocks plummeted, gold surged from around $800 per ounce to over $1,800 by 2011. 2020 COVID-19 pandemic. As the world went into lockdowns and markets panicked, gold prices again soared, breaking $2,000 per ounce for the first time in history. 2022-2023 inflation surge. With inflation hitting 40-year highs in the US, the stock market stumbled. Meanwhile, gold remained stable, providing a shield for many portfolio. These aren't coincidences. It's proof that when uncertainty rises, gold shines. Why gold holds value? But why does gold hold its value so well? There are a few reasons. Scarcity. Gold is finite. You can't just print more of it like paper money. Intrinsic value. It's been valued by civilizations for millennia, from the Egyptians to Wall Street. No counterparty risk. Unlike stocks or bonds, gold isn't dependent on any institution's promise to pay. Hedge against inflation. When the value of the dollar falls, gold often holds steady or even rises. Think about it. In a world where central banks can print trillions of dollars overnight, gold remains gold.
2. Government bonds.
Government bonds, specifically midterm treasury bonds, an option that may not make you rich overnight, but is incredibly reliable. So what exactly are treasury bonds? These are debt securities issued by the US government to fund public spending. In simple terms, when you buy a treasury bond, you're basically lending money to the government, and in return, they promise to pay you back with interest. Why are midterm treasury bonds getting a lot of attention right now? First, they usually mature in 5 to 10 years, which strikes a balance between earning steady interest and not having your money locked up for too long, like with 30-year bonds. Second, during uncertain economic times, like when inflation is high, stocks are volatile, and talk of recession is everywhere, investors crave stability and predictability, and that's exactly what these bonds offer.
Especially midterm treasury bonds. Not huge returns, but reliable. 3. Dividend stocks.
Why dividend stocks are safe during economic uncertainty. Consistent passive income. Dividend stocks are shares of companies that regularly distribute profits to shareholders in the form of cash dividends. In uncertain economic times, dividend income provides a steady cash flow even when stock prices are falling. Example, stocks of companies like Coca-Cola, KO, or Procter & Gamble, PG, continue to pay consistent dividends even during crises like 2008 or the 2020 pandemic. More stable and crisis-resilient companies. Companies that are able to pay dividends regularly are generally large, established, and financially healthy companies, operating in the consumer staples, utilities, or healthcare sectors where their products are always in demand. Example, Johnson & Johnson, a healthcare company that remained strong even during the pandemic, continues to pay dividends because its products are always in demand. Lower price volatility. Dividend stocks tend to be more stable than growth stocks, such as technology stocks, because investors hold these stocks to receive dividends. Demand for dividend stocks remains high, so their prices are less likely to drop.
Dividend stocks are a safe bet because they provide stable income, come from fundamentally strong companies, and tend to be more resilient to economic turmoil. In times of uncertainty, such as the threat of a recession or high inflation, having dividend stocks in your portfolio can act as a cushion, keeping your wealth growing slowly but steadily. Stick with big established companies that consistently pay dividends, particularly in energy and healthcare sectors. 4. Dollar cost averaging. Dollar cost averaging and DCA is an investment strategy where you invest the same amount of money regularly over a specific period of time, regardless of whether the asset's price is rising or falling. In other words, you invest consistently, for example, $100 every month in stocks, mutual funds, or other assets, regardless of whether prices are high or low. If you still want exposure to the stock market, buy consistently in small amounts rather than investing all at once. And don't forget, always have an emergency fund that covers at least 6 months of living expenses.
If you want a more complete explanation of the various types of investments that are suitable for the current uncertain economic situation, please click the subscribe button on this channel, because in the future this channel will discuss this topic a lot. Now, will the US face a recession? Many economists predict that if the Fed keeps interest rates high for the rest of the year, we might see a mild recession by the end of 2025. But if inflation can be brought down faster, we might just experience a slowdown without a full-blown recession. That's why staying updated with economic data is so important. That's the June 2025 economic update from Copyac Duo. If you enjoyed this video, don't forget to like, subscribe, and turn on the notification bell so you won't miss our weekly financial updates. Drop a comment below. You think we're heading into a recession this year? See you in the next video.